Okay, so today I want to talk about unemployment. There's three types of unemployment, and I also want to talk about where we are today. Okay, so when you talk about unemployment, everybody's talking about AI. Everybody's talking about, am I going to have a job in the future? Am I scared? So I just want to be able to give everybody sort of an economic view of what's happening today, and what's happened in the past, and sort of build the trend and give an idea of where we are today. So um, as we get into it, my name is Jimmy Theok. I um, been in the workforce for about 20 years, and so I'm actually caught in between some of this as well. And with the time, I'm a economic I love economics a lot, and so one of the topics I love talking about is sort of employment, unemployment, how do we create jobs, how do we be more efficient, how do we grow GDP. So those are things that are very interesting to me. So I do want to spend some time talking about what's on everybody's mind today. So unemployment's a pretty big deal. I see if you're watching the news today, you probably hear a lot about jobs that are being created. I think the last few months we've had jobs being up, more specifically in the health sector, and in that sector we're seeing a lot of growth with regards to people being in those fields and being able to support sort of the older generation. As you guys know, the baby boomers are getting older, and they'll need some more support. And so we're seeing a lot of growth in that sector, but not much growth elsewhere. Okay, so what dominates the news on the other side is going to be news about sort of technology, where AI is sort of being um, is taking away jobs because companies are becoming a little bit more efficient, and so therefore a race to be more profitable. So if we have better tools, can we actually be more efficient and make more money? Okay. So as we get into it, there's three fundamental. When you look at economics, the economic structure of how things are, how unemployment is sort of measured, or how unemployment is actually looked at. There's three things to know, and I'll go through some of the context of that in this session. When you look at the U.S. unemployment rate, one of the things you want to be you want to know, and so this is a chart that is on the government site today. It's a Fred site from St. Louis, and it measures unemployment, the unemployment rate, and this for this chart specifically, this is from 1948, so post World War II. And if you could look at it, if you don't never looked at these before, the gray bar represents a recession. And so during a recessionary period, you can sort of see that those gray bars. And so for every time the unemployment rate spikes up, you can sort of see it drops back down. And when it spikes up, we typically look at those as an increase of folks not having jobs, and so unemployment just drives up. And each of those spikes, you can sort of see correlates with being inside the gray bar. And for each period afterwards, you see a sharp drop. And so those are sort of an economic boom, and then you sort of see unemployment drop. Looking at it, the Great Recession, I don't have the Great Depression on here, but if you look at the Great Recession back in '06 through '08, see the bar is pretty thick there, and see how high unemployment has been. We have not had a recession since then, of that nature, since that period of time. The next spike of unemployment you see there is going to be COVID. Okay. And that sharply drops. And so through 2020 through 2024, you sort of see sort of a low period of an unemployment rate. Okay. And so I bring this up because I want you guys to be able to understand sort of the structure, what unemployment looks like when it's being talked about, and why it's important to sort of keep an eye on this. All of these are economic, and if you look at the 80s and the 90s, you see a lot of bars sort of consolidated together, right? So that was a pretty interesting period between sort of interest rates, conflict with war, oil prices, and so a lot of that was really condensed in those period of time between the 80s and the 90s, and then you sort of a little bit more gaps in from 2000 onto now. Okay, if you look at sort of frictional unemployment, which I call a little bit more a healthier version of the economy. And so, hey, so it's sort of in between jobs. The we create a lot of jobs, whether it be manufacturing, whether it be healthcare, whether it be tech, um, whether it be service. So the economy has so many different verticals of job categories, and not everybody per se is in the right spot at any given time. And so to get everybody to the right spot, there's some form of friction to get to the right spot. And so we did see a lot of that during the Great Resignation, where we saw a lot of folks just sort of bouncing through jobs to get to the right spot, right? So workers leaving one job to find a better one, graduates coming out of high school or college, entering the labor workforce, career changes, relocations, people coming in. So this is very, very healthy, right? So very healthy. It's just natural. The good thing is that we have jobs, right? So we have jobs. People are getting jobs. We're just going to put people in the right spots. And so, hey, I'm at this job, not really a good fit. I could be better at that role. So about a week later, you probably give your 2 week notice, and then you got a job probably in about a month somewhere else. And so typically you want to be able to see what we try to shoot for, what the U.S. Economy tries to shoot for, is to have a little bit more friction in their workforce. And so this is sort of a good thing. And so unemployment between jobs, just to clarify sort of the definitions. So when you get to structural unemployment, this one's a little bit harder, right? And so this is where if you look at it, it's going to be a little bit more difficult for folks on this one, because what typically tends to happen during a structural recession or structural unemployment, or a recession that starts off from a structural standpoint. So this is where, hey, it is more efficient to move jobs overseas because we could get a better labor cost, a much more competitive output than doing it here. So we saw a lot of that happen um, in the 80s and 90s, where we saw manufacturing jobs disappear. And so, and the skill sets that are left are not the skill sets that could actually help us get it done. So in this case, when you have structural, the economy needs workers, just not these kind of workers, right? And so these guys, they don't have the skill sets to do it. So we have the skill sets or the financial means to be able to do it somewhere else for a lot lower costs is one of it. And the other one is sort of going to be technology, is where we have, hey, we're going to move your job, and we're going to put robots in to do it. And we don't have your skill sets that doesn't allow you to have another job that you could actually be good at. And so you're just unemployed. Uh, so structural is a very, very hard one to take. I think you see a lot of industry declines where they've sort of shifted and consolidated. And so we don't typically have a lot of structural quite often. Um, and so when you see these are very, very hard on the people that it could be in a certain area, sort of the Midwest. We've seen that happen in the past where, so what do those people do with regards to their skill set? Go back to school, uh, pick up a new craft, learn something else to sort of avoid what a structural unemployment wave looks like. Okay. Typically, structural is going to be a little bit longer in duration. In some cases, from months to years. Sometimes it's permanent, right? So a great classic example of that is from sort of whether horses to cars. So and we'll get into that as well. Cyclical is going to be sort of that unemployment that happens sort of like periodically, and so we know that demand just sort of drops, maybe global demand, maybe sort of regional demand, and so you have a lot of cyclical component to it, whether interest rates go up so high that everybody, so demand just sort of drops. So we have a lot more cyclical recessions as well, because the last recession that we had in the sort of Great Recession was sort of was classified more of a cyclical component based off of a lot of what happened with interest rates, what happened on Wall Street, with housing and everything else. So that was the last big cyclical component of a recession. And what tends to happen is that demand falls, companies just start cutting headcount across the board. You start seeing that across multiple industries. And it's tied directly sort of to sort of a contraction, and everything sort of contracts, and you're like, we don't have, so our base cost as an organization is too high. So what you tend to see is a lot of companies sort of says, hey, we got to cut down to the right spot based off of where we're at and sort of demand. What also happens is a lot of companies also see it a little bit. It hits a couple more industries, sort of at I would say more of a domino effect. And so, hey, what if people are not don't have jobs, or they're not going to fly, they're not going to go to hotels. So you didn't have a lot of that. So then you have not going out to dinner. So a little bit of a domino effect with it. And so that sort of carries a lot of problems with it. So that's in that sense good. So if I had to sort of rank these three, and there's frictional, structural, and cyclical. I would say from worst to somewhat good. None of them is actually good, although because people are losing their jobs. I would say structural is really rough. Then you have cyclical, and then I would say frictional would be sort of my rank. So let's get into some of the sort of examples here. So tractor replaces the mule. So in 1920s, you saw the person that was working on a tractor or on a mule, and so the mule was probably sort of conceptually pretty cool technology. You could take an animal, put something on the back of it, and they could help you sort of yield your crops, right? And sort of instead of you doing that by hand, how we did it before. And so that allowed you to pick up, but hey, technology got better, right? And so we got some new inventions. People going to college, learned some engineering crafts, and hey, we could build a tractor to make this even faster. And so, so those are kind of things that when you look at it, so those created sort of disruption in the workforce. We don't need you to ride a mule anymore. Can you actually work this tractor and be better? And so, so the folks that were just really good at doing the mule but weren't able to conduct a tractor essentially lost their job, right? So a great concept of more of a structural change. When you look at the Great Depression going back into the 20s, still in the 20s, so this is a very interesting period of time where our unemployment rate drove up to about 24.9, which is the highest we've ever sort of recorded it. And so that meant a lot of people didn't have jobs. So it was a very rough time in our history. And credit was frozen. We got a lot of runs on banks, a lot of families with no form of income. So we've since then implemented a lot of laws and policies around that. The SEC came out of that as well during that period of time. And so this is sort of that part of, hey, how do we avoid these kind of scenarios where we have mass unemployment to that level, right? So and so at that point, that it had built up to that point, and then it sort of crashed all at one time. Soldiers coming home. And so after World War II, or World War One, you had a lot of soldiers coming back home, and so you had a movement of folks coming back, so the workforce sort of opened up. Of course, when you have 4 million folks coming back, service guys coming back, where do you put them? And so that creates what I would call more of a friction um, into your employment cycle at that point. And so, but we were able to absorb and create jobs for them in that time. I did have my slides a little flip around, but we do have where we had everybody come back. You had to find a way for them to actually have an ability to have a job, and so we were able to actually find jobs for most of these folks. When you look at sort of the last 40 years of recessions, in '82 you have the Volcker recession. Volcker was part of sort of the Fed chair at that point, and raising the interest rate does have an impact on demand, right? So if I raise the interest rate, the cost of money becomes pretty expensive, and in most cases, businesses typically will their capex spending on expanding becomes a little bit more costlier, and so it's easier for them to actually sit tight and wait for cost of money to come down. That does have a material impact on what happens in growth in regards to opportunities for people to have jobs. And so in '82, you saw some of the recessions be driven there, as I talked about earlier. The '80s and '90s, you saw that the recession bars were really close to each other, right? And so in '82, what you saw was sort of a recession where we saw 10.8% unemployment. And so the Feds raised their rates at that time to break inflation because inflation was really, really out of control. And and so unemployment, as a result of raising it created a recession. Okay. And so for those who are paying attention, you could probably classify what kind of recession that probably is. And so if you're saying cyclical, then you're absolutely correct. Okay. Then in '91, what you saw was the S&L and Gulf War. And so where we had a banking crisis, an oil shock, a lot of white collar jobs were gone. And so saw oil price spike as well. And so that created sort of another recession at that period of time. You saw 7.8 in terms of unemployment rate. The dot-com bust, for those who remember those, we saw that happen pretty promptly. I think that if you are like me, graduating high school around 1999, and you look at, hey, the world's going to end at 2000, but there's also sort of an underlying other storyline that was going on at that time, the dot-com bust. And so you saw a lot of companies that made a lot of bets that didn't actually play out. And so that had a material impact on demand at that point. And so again, these are all cyclical. So in regards to what they are, these are all examples of what a cyclical recession looks like in the last 40 years. And then of course the last one was a Great Recession. It was in 2009, where unemployment spiked up to 10%. A lot of it driven up by, for those who remember, from Wall Street. I think if you wanted a house and you somewhat could actually sign a application for a mortgage loan, you could get it. And so you had a lot of people that had loans that probably shouldn't have had access to loans. And so when all that defaulted, you saw demand pull back quite a bit. A lot of concern, a lot of folks were pretty scared from both the business side and the consumer. So when you actually have a natural contraction from both sides like that, it's gonna drive back quite a bit of your demand side. And so and what ended up happening was sort of a prolonged recessionary period. I do have a sort of moniker there. Every cycle looks different, but every cycle ends with the same pretty much the same way. People lose jobs, right? So it comes in different ways. It looks differently. But at the end, it does look. At the end, people do lose their jobs. So something to remember. Sort of structural change, sort of the long hollowing. So when you look at the '80s, you saw the Rust Belt decline, where cars, steel, sort of that heavy manufacturing industry sort of got ripped apart a little bit. And so you saw a lot of those jobs move to sort of the Asian countries where the cost to actually create them is substantially lower. It's lower in so many different ways of the labor cost and also uh, and then of course the finished product was lower than what we cost to even started off with labor. And so what ended up happening was so a lot of the leadership in those industries said it was cheaper for us to not only have the labor and then have a finished product, but we could also ship it back to the U.S. and it still be lower at a lot lower cost than we even started off with just having the overhead here. And so that did a lot of things to sort of Detroit area. For those who've been there in the past, so that hurt that industry quite a bit. You saw a lot of the steel industry sort of in Pittsburgh. So from a structure standpoint, you had a lot of workers that were displaced, and that's what generationally they were doing for a very long time. And for them to say, hey, we were doing my grandfather was doing this for a long time, my dad was doing this for a long time, and that's all I know how to do. And so so a lot of those folks had to sort of relearn new skills to be able to support their families. But those jobs were not really coming back. I know Donald Trump, as most recently, has been trying pretty hard to get a lot of the manufacturing to come back to the United States by implementing tariffs to do that. And so typically a tricky part to do, but certainly there was a lot of damage caused decades ago with regards to where manufacturing jobs are going, right? And so that created a pretty really big hole in our sort of workforce. The NAFTA agreement and outsourcing. You saw a lot of jobs move to sort of it's just a sort of same theme here in the 90s. And you can sort of, if you look at this, there's a lot of like manufacturing jobs, a lot of steel jobs that are going away from the U.S. because they felt like other countries will do it closer to a lot lower number than doing it here. And so the theme is fairly the same through the 80s, 90s, and the 2000s. So you saw in 2000s, WTO entry hits a U.S. factory employment, and essentially cost us 2 million jobs. And so the Asian countries, or again, similar theme through these decades, is that we could do it a lot cheaper and give you back what you want at a lot lower cost. And then of course the companies that own these processes could sort of have a better margin, right? So you still have shareholders that you gotta be able to account for, and so you're giving your shareholders back sort of better value for their shares because you're able to sell to the public a product at a lot higher margin, right? So that's sort of the background on that. The 2010s, when you look at automation, and we get into this a little bit more, is the question I would ask everybody here is that, are we in a structural change today, right? And so because you look at automation and software in the 2010s, it created some displacement where routine work could actually be done fairly easy with better coding, right? So you have companies with AWS became really big with servers and how they actually manage stuff in the cloud. And you're able to actually do a lot more with better technology where, hey, I needed a human to do that, but I can actually sort of like do it. I can automate that. I don't know if any of you guys remember where we used to have, and I'm dating myself here, but the senior millennial moment here is that you had operators, if you just dialed 0, they would plug you to another spot. And so all of that went away from where you talked to a real operator to, yeah, I have a cell phone now, I don't really need to do that. I can sort of like just text. And so all this to say is that, like, hey, certainly you take certain segments that could be done better with technology and automation and software, you could erase a lot of cost layers that, hey, we were just a lot more efficient, we're a lot faster. And so that's sort of a real thing. I think it's actually expanded now with OpenAI open to the world back in 2022. I do think that gets a little bit more interesting as we go through the next few years. I do think that the curve of adoption on that is going to be substantially more uh, uh, affecting to the U.S. population that's able to go to work as well. So, and then when you look at frictional, which I call the healthy churn, the 1990s tech mobility, uh, engineers just and I give an example where engineers jumped from Silicon Valley to other startups, and they were creating really good things. And so you didn't work here, you had a good opportunity to go somewhere else and be able to really do what you wanted to do. You could do it, right? And so you could be able to create different things based off what you're really good at. You can look at construction. I'm really good at doing this particular trade, being electrical, but they allow me to do a little bit more of a project and run a project at that site. So at that organization, so I'd rather go there. And so the 90s, you saw a lot of the tech mobility sort of help. And again, those are very, when we bounced out of those recessions, you saw a lot, unemployment dropped. Um, and people that had job openings and funding were able to actually hire different people to come do that. And plus, they had the demand of the technologies really wanted in the market. Okay, so in the 2000s, we saw a lot of the service sector churn, where we some would say like we became a little bit more of a service economy base, where a lot of retail, hospitality, logistic. And sort of that constant grind of getting everybody in the right spot of some of those segments. And so, and hey, maybe you didn't work out there. So we saw a lot of churn in the service sector back in the 2000s. And the 2015s, I alluded to this earlier, the quit rate was pretty high as people sort of like look for spots to really land. And so you saw folks and companies were trying to keep incentives to keep people where they were, or like, hey, how can we sort of like, so it was more of a workers market back then than it was sort of the company. Today it's sort of like flipped, right? So companies do have sort of a bigger pool to choose from. In this period of time, it was completely opposite, where the workers could choose wherever they wanted to go, and it was okay. And typically, you really want sort of more of that dynamic, be it not probably too much to the worker or too much to the company, a little bit more in the middle, and then allow it to sort of work its way. So, and so that's sort of where that period of time was. And then of course in 2019. A little bit of friction before the COVID period of time, where we saw a very tight market with labor as well. So, and in 2019, we saw a lot of quiet quitting, folks that are just like coming to work and they're looking for their job, right? So we saw a lot of those dynamics back in that time. But it also was a confidence of the workforce that felt that, hey, there is something better for me to go do, and if I could do it, I'm going to go do it, right? That is not the case today. Everybody's holding on to their seats. Everybody's saying, hey, I need to keep this job. I need to be able to support my family. Even though I know I may be a bad fit here, I don't like it, or I hate it, whatever it is, I'm going to keep the job. Back in 2019, if you hated your job, you could go get another one in 2 weeks. Okay, so those are things sort of like that are really critical when you look at sort of the three sort of pillars there. Between cyclical, structural, and frictional. And so when the economy is healthy, the unemployment that's left is mostly about sort of emotion, right? So it's mostly about like getting everybody to the right spots. Okay. Uh, Last slide I'll talk about is where are we today? Like what is the uh, where would we say that we are today, right? And so the unemployment number says one thing. Yet we get it the first full week Friday of the month from the government, and so it says one thing, but we feel another difference. Just reading a story today where I think a young lady, really talented, 10 years experience in a senior leadership role, she's applied for 1,000 jobs, and she's probably had close to 1,000 rejections. Uh, and that's been very consistent through the stories I read every week. And but then you get a report like we did last week. I think that unemployment's is staying steady at 4.3%. But yet I think you have a lot of folks that are probably just sort of not really in the right spot or not getting jobs, right? And so we talked about frictional. So that quits, collapse, workers feel stuck. Mobility is no longer a sign of confidence, right? So those are things that you want to think about there. Structural AI offshoring, and pulling the floor out from under the knowledge work quietly before the data series sees it, right? And then of course cyclical hiring rates have softened industries that lead the cycle. I'll talk about these three real quick, and I know I read through the slides there, but here's my thoughts. I think that from a frictional standpoint, I don't think that right now we are in a frictional space. And I know I'll write my decision there, but I do want to sort of speak to it for a little bit. I also don't think that we are I think we're in a cyclical phase where I feel like interest rates, monetary policy between should we raise interest rates, should we not raise interest rates are critical, right? And so, and in my thinking there is that we got a really good run up from 2021 to 2023, early 2023, and so from that period of time, that was a really, really decent run up in the economy. We did very well across many industries. Since then, I think that what ended up happening, inflation got out of hand, right? So since then, I think the Fed's been raising interest rates. And I do think that there's a slowdown at some point. It typically happens when interest rates get that high. And so what tends to happen, obviously, is that, hey, we're going to slow it down, right? And so interest rates go up, and it slows down sort of demand and everything else. And so that typically drives a cyclical recession. Okay, so, but with the other thing that we're seeing is sort of this AI component being added to it that's making it a little bit tricky that we've never seen before. When you talk about structural changes in the last 100 years, yes, we got rid of cars for horses. You got rid of horses for cars, mules for tractors. So some of that could be isolated to certain industries. What we're seeing today is not isolated to the industries. It's pretty much every industry is impacted by it, right? So the technology is so good that every single industry is impacted by that change. And so when I look at this, so have we ever had a scenario where it's cyclical and structural? And I don't think that's ever been the case, but we may be upon one. And so what I write down there is that we're watching a structural shift wearing a cyclical mask. And the structural part is AI, and the cyclical part is sort of what the Feds are doing with interest rates. Houses, who could buy a house these days because of where interest rates are? And of course, those are a couple things that are just sort of impacting the economy. And the question is, what needs to happen going forward to sort of change the dynamics of this a little bit, right? And so you don't want a very prolonged structural shift, especially to the one of this nature, where if its technology is so good and every company is incentivized to return really, really good profits back to their shareholders, do the companies without policy take that more often than not than what's good for the American public? And then, of course, what happens, I think we want to make a Fed change chair that's a little bit more friendlier to interest rates. And so what you also don't want to do, and of course we have a conflict in Iran, is that you drive up interest rates to another level because oil prices are so high. You have to manage sort of the inflation. Inflation numbers came out today. I think we're sitting a lot higher at 3.8, but a lot of that's driven by where oil price is as part of what's happening as you guys go to the pump to get gas. You're once at one time paying $40 for F-150 truck. And now you're probably paying close to $100 for that same amount of gas. And so that's sort of the driving nature of what's going on. But if you're caught in a scenario today, and you're thinking about like what's really happening in the economy, think about these three pillars of is it a frictional change where hey, I feel good about going in to get another job. I'm just in the wrong spot now today, and it should be easy. Is it a structural change where they're just moving this whole thing to something else, and I'm not equipped to do it, and so we've also seen a lot of retirements happen as well because of that. And then is it a cyclical change, right? And so of course you look at sort of the cyclical nature of recessions, of demand drops everywhere, and we're all going to wait it out and see what happens, and then get back on our feet in about a year or two, and then off we go. So first time in American history, I feel like it's probably closer to more structural cyclical. So if you think about where we're at today, so feel free to leave any comments on my YouTube channel. Subscribe. I have more of these conversations about these kind of stuff. So I love these kind of topics, and so love to hear from you guys about what you guys think about where we are today in the economy, and then get your perspective and possibly what can we do about it, right? So those are all really, really cool points that I love to read from you guys. And again, thank you for taking the time to actually listen to my presentation.